Welcome to REITs in a post-COVID landscape, a four-part webinar brought to you by The Edge Singapore. The series is sponsored by Elite Commercial REITs and RHB.
Hello everybody, welcome to The Edge Singapore's REITs Investment Forum titled REITs in a Post-COVID Landscape. Singapore is viewed as the REIT hub of Asia, with the largest REIT market in Asia ex-Japan. Some 43 REITs and property trusts are listed on the SGX, with a market capitalization of around 100 Singapore dollars, or 12% of total local market capitalization. As at April 2020, 86% of REITs and property trusts by number own properties outside of Singapore, and 17 REITs real estate portfolios comprise entirely of overseas assets. Now, one or two of these had governance issues, and our regulators are ironing these out to ensure these problems do not resurface with new REIT IPOs, particularly those with sponsors that are not based in Singapore and are an unknown quantity here. Of course, there are risks and opportunities in our enlarged REIT universe. With COVID, retail REITs and hospitality trusts have been negatively impacted. To take us through some of the issues that both investors and REIT managers have to grapple with, we have Vijay, Real Estate and REITs Analyst from RHB Securities, who will take us through his presentation, Choosing the Most COVID-Resilient REIT. Sit back and enjoy. Over to you, Vijay.
Thanks, Kula, for the introduction, and thanks, Edge Singapore, for giving me this opportunity to present on Singapore REITs. It has been a great start to the week. I think with the outcome of the US elections becoming more clearer, and there has been some good news on the vaccine front also. I hope a vaccine is out soon so that some sense of normalcy returns to life soon. The topic I'll be presenting here is choosing the most COVID-19 resilient REIT. I would actually divide this topic into four topics. Firstly, I would give a bit of overview about the S-REIT sector's performance year to date and what is our outlook. Then I would go about what should the investors look for in a COVID resilient REIT, not just COVID, a resilient REIT across market cycles. Then I would share a brief outlook on the sector, followed by our picks. Let's move on to the first topic of S-REIT's performance and outlook. 2020 has been an eventful year. COVID-19 has completely changed the landscape of global economy and real estate as such. COVID-19 has so far had an uneven impact across various asset classes in REITs. But so far this year, REITs has managed to ride through this cycle in a much better fashion, mainly because as REITs enter into this cycle, the balance sheets were relatively quite healthy. Portfolio was a bit more diversified, and more importantly, the current low interest rate environment and abundant liquidity in the market has benefited REITs. As you can see from the chart on this left, S-REIT's performance this year has also been on a roller coaster ride. During the month of April and May, S-REIT sector fell by close to about 40% at one point of time. But since then, as you can see on this chart, S-REITs has recovered nicely with investors' continued hunt for yield. As of 8th November, S-REITs are down about 7% year to date, compared to that of the STI's 20% down year to date. Still, S-REITs are about 20% below the recent peak levels, which was seen in 2019, beginning this year. One difference recently seen in S-REITs, not just in S-REITs, across many of the sectors, is that retail investors, because investors like you and me, or investors like small family offices, have emerged as a net buyers in this crisis. If you look at this chart, what you can see is that since March, retail investors have been a net buyers across most of the months. And year to date, retail investors has poured in more than 700 million into S-REITs as net buy-in effect, whereas institutional investors has been a net sellers. This is not surprising for various different factors. One being the low interest rate environment limiting the savings option, pushing retail investors into REIT sector. The COVID-19 lockdown has also resulted in resurgence of overall interest in stocks by retail investors. And last but not the least, Singapore has been gaining traction in terms of global wealth management hub. We are seeing a lot of family offices, small fund houses being set up in Singapore, and usually these family offices and fund houses have at least a good portion of their portfolio in terms of yield instruments where REITs fit in nicely. Okay, this slide gives you a peer comparison of the REITs in the universe. With the recent merger of Capital and Commercial Trust and Capital and Mall Trust into Capital and Integrated Commercial Trust, we now have about 40 REITs in the sector. Current market cap is about 73 billion US dollars, and REITs offers an yield of slightly more than 5% at this point of time. The REIT sectors is broadly classified into 6 different sectors. This is based on our guidelines. We classify the sectors into office, retail, industrial, hospitality, healthcare, and overseas. Not surprisingly, industrial sector has been the best performing sector year to date, with the sector up nearly about 15% year to date, while hospitality sector has been the hardest hit by the COVID-19 pandemic so far. We will be discussing more in details about the brief sector outlook. So I would just give you a glance about how the REIT sectors have performed so far. Let's just move into the S-REIT sector's valuation as such. The most common question investors ask is that S-REIT seems to have run up quite a bit in the recent years. Are S-REIT valuations expensive? Is there still merits to invest in S-REITs, or S-REITs expensive? I would say that, so looking at this two charts, these charts give you an historical perspective of how S-REITs are traded. The chart on the left is the dividend yield spread, which is actually the yield spread over the 10-year government bond yields. The chart on the right is the price to book chart, which gives you a historical price to book values. What you can see in this dividend yield spread chart is that S-REIT still trade at about 420 basis points above the 10-year government yield and are still at mean levels. No thanks to the low interest rate environment, which has made the 10-year bonds yields as low as less than 0.8% at this point of time. So thus making S-REIT's yield even attractive at this point of time. Even looking at the price to book perspective, S-REITs don't seem expensive. So my short answer to S-REITs valuations is that valuations are not cheap, but if you compare on a historical basis, it is not expensive either. So overall, I think there are still some room and merits to continue investing in S-REITs at this point of time. The next one is that where does Singapore REITs stand among its global peers? And is there an increase in interest from overseas investors into Singapore REITs? The short answer is yes. We are definitely seeing increased interest in Singapore REITs from many of the regional economies like Thailand, Japan, Taiwan. Not just that, even many overseas markets like UK, or US, and Canada has also shown a greater interest in Singapore REITs in the recent years. The key reason is this. You can see that overall yields of REITs are still about 5%, which are greater than much of the other REIT markets in the world. And you have to take note that this 5% yield is also slightly impacted by COVID-19. As you know that this year, many of the REITs has given rent rebates, and this 5.2% yield is actually 10 to 15% lower than the normal rate of yields for the S-REITs at this point of time. Despite that, S-REITs, as you can see, that the yield spread over the 10-year government bond yield compared to other markets is still sizably higher at 4.4%. Again, this has been reflected in the year-to-date performance. As you can see that Singapore REITs year-to-date is down by about 7% year-on-year. Only Australian REITs and US REITs so far has done better than Singapore REITs. Again, showing that Singapore REITs are still among favorite for the overseas investors, not just local investors as such. The other thing which has been of interest this year is that over the last 2 years, acquisition momentum has clearly picked up. In the last 1-2 years, in 2019, S-REITs acquired more than 10 billion worth of assets. The first half of this year has been acquired in terms of acquisition trend. Not surprising. Things were really shaky in the first half, considering how COVID-19 changed the entire landscape of the world. But since then, in the second half of the year, acquisition momentum has come back quite strongly. In fact, REITs has made 4 times more acquisitions in terms of acquisition value compared to first half year to date in the second half of the year. This can be seen in this chart. Again, this doesn't include the latest Ascenda's REIT acquisition of close to 2 billion in portfolio, which they are planning to acquire. So if you include that, as REITs year to date are acquiring, have proposed an acquisition of close to $10 billion worth of investments. That is no small amount. It is in fact coming closer to what they have acquired last year. What has been driving this acquisition momentum for the REITs? One, if you have to take note, I think earlier this year, MAS has raised the REIT sector's gearing limit from 45% to 50% in light of the global uncertainties. That has provided a bit more headroom for the REITs. But this 50%, I have to say, is still in line with what other major global economies or global REIT markets in terms of gearing limit. Other than this, in general, I think as REIT share price has risen in the second half of the year, the dividend yield has compressed. So it makes the REITs to issue equity and acquire assets. The ultra low financing cost and banks still being supportive in terms of funding has also helped the REITs to acquire more assets in this market. Uh, Considering how COVID-19 has impacted the portfolio, as REITs are now more keen to have a diversified portfolio, not just in Singapore, but globally, to make sure that they don't get caught on the wrong side in any of the single asset class as such. Again, not surprisingly, industrial and office have been the key focus sectors for S-REITs in terms of acquisitions. These two sectors have performed relatively well compared to many of the other sectors. So again, this is not a surprise. And I think in the medium term, we still expect more acquisitions to come from the S-REITs, mainly on the industrial and office sectors. Quickly, maybe let's just move on to the outlook quickly on the S-REIT sector. Despite a weak economic outlook, I know that we are not out of the woods. There are clearly a lot of risks underlying in the economy, with job losses being the topmost among it. What we have seen so far is that things have started to improve from the second quarter. No thanks to, government stimulus and support measures, which has aided in a large extent to prevent a deep and severe economic recession. Judging at this point, things are improving sequentially, things are improving quarter on quarter. And in general, investors' interest in yield instruments like S-REITs continues to remain high in this market, mainly because of the abundant liquidity and lower for longer interest rate outlook. The other thing that's different from the past sector in this crisis at this point of time is that there has been a coordinated central bank response across the board, even from ECB, from Fed to JCB, and many other markets. Central banks have responded in a uniform manner to avert a crisis. So, in general, unlike past crises like 2009 crisis, we saw a financial crunch crippling the REIT sector. This has not happened in this crisis. REITs has also learned very good lessons from the past crisis and has been diversifying their funding sources and keeping their balance sheet in a much better shape. If you look at the latest US outcome elections, with the Democrats Joe Biden leading and is set to take power in the US country as president. The thing is that at this point of time, it looks like Senate is going to be going with the Republicans. Uh, the prediction at this point of time, the expectation at this point of time is that having a Senate-led, Republican-led Senate and a Democrats-led lower house is going to have a reduction. I mean, the fiscal stimulus are going to be much more difficult to pass through. So what this means is that monetary stimulus is going to be lower, is going to be there for longer. That means interest rates are going to stay for a longer period of time. This is generally supportive for REIT sector. As I said in the earlier slides, Earnings as such has bottomed out for the REIT sector in the second quarter. We are seeing good improvement in terms of earnings for all the REITs in across all the sectors. REITs has also starting to distribute some of the retained income with an improvement in the overall macroeconomic outlook. So overall, we expect at this point of time, 2021 should be a much better year in terms of DPU. We expect the overall average sector DPU to increase by 10 to 15 percentage point in 2021. The other concern which many investors have is that what is the cap rates and valuations? We have generally seen that capitalization rates or cap rates has remained largely steady. Again, this is due to the lower interest rate environment and a lack of distressed sale in this market. So thus, the book values of the REITs are also unlikely to see a big decline. We expect an average of 5% decline of book values, which we think is manageable for the Singapore REITs. So in summary, we still continue to remain positive on the REIT sector, but I don't think so investors should buy across the board across the REITs. I think large cap REITs mainly has run up a fair bit, but we still expect investor interest to remain in large cap REITs high. But from an upside perspective, we see a bit more value in terms of the small mid cap space as well as laggard plays, some of the specific overseas REITs which have longer WALEs and which have higher yields might might have a bit more upside going forward at this point of time. And we will be discussing that also in the later slides. So moving on to the second part of the presentation, I think this is the crux of the presentation, is what are the key factors of a COVID resilient REIT? Not just COVID resilient, as I said, a resilient REIT across the market cycles. I would keep this part more of a prescriptive in nature. The main reason is because market dynamics keeps changing and market dynamics keeps moving. So the objective of this part of the presentation is to give the investors or empower the investors with information so that you can analyze your own REITs in terms of how this is positioned to weather the market cycles. So I would look at REITs or how to see the REITs as a resilient from 6 different factors or 6 characteristics which will make REIT resilient to me. Firstly, macro outlook and positioning to changing market trends. This is very, very important as COVID-19 has shown. A lot of things has changed over the last 6 to 9 months. The most important of them is the digital trends as well as the changing global supply chain. COVID-19 has also had positive impact on certain sectors like data centers, logistics, etc., but has brought about quite a bit of structural challenges for sectors like retail and near-term challenges for sectors like hospitality, etc. So what this basically means is that the investors are going to look at different asset class differently at this point of time, and they may not be willing to pay the same price to book or valuation multiples which they have been paying in the past. So it doesn't mean that all retail REITs are bad, investors cannot invest in retail REITs, but investors have to look at how the sectors which are being impacted, which means the retail as well as the hospitality REITs, are adapting to the changing market trends. For example, if it is a retail trend, how retail REIT, how are they embracing the changing digital trend? How are they positioning their assets in terms of change into e-commerce? Are they still old brick and mortar style retail REIT? Are they changing to the omni-channel trend? This is very, very important, and when you look at the REITs which you are buying. Similarly, for hospitality REITs, how are they ensuring safety and eventually when a rebound comes, how are they positioned in terms of a recovery? That's important. And the valuation metric, especially for these asset classes, are going to be a bit challenging. So firstly, investors has to look at what does the REIT hold underlying assets and are they future proof? What kind of valuations metrics would be appropriate for these assets is something which we have to look into. Just because a REIT, again, as I said, industrial REITs has been the darlings of the market. No surprises here. This has been the best resilient asset class in this market so far. But just because a REIT is industrial or positioned in logistics or data center makes it uh, future proof. Even in the sectors like logistics and data centers, things are changing. So the REITs has to adapt to the changes. For example, in Singapore, ramp up logistics are much more popular than a typical normal logistics house. So are the REITs upgrading their assets? Are the REITs positioning the assets to capture these changes in the market? Is what every investors. So the objective of this here is that what is the asset class and how the managers in the asset class are positioning the assets to changing market trend is a key for every investors to look into the REITs. This is a most important point. I think this is still, I would say, at early stages if you look at from a Singapore market perspective. Adoption of ESG trends, environmental, social, and governance trend. But I can see this in next 1-2 years. This is going to get more and more and more prominent among REITs, and investors would be grading REITs in terms of how good they are adopting to the ESG practices and ESG metrics. Why this ESG metrics is important and how this will benefit a REIT and how this will make a REIT resilient. Firstly, a REIT which is early adopter in ESG practices qualify for a wider pool of investment funds. Many big funds like BlackRock have openly come out and said that if an underlying stock doesn't take ESG seriously, we would be shunning away from investing in these kind of asset classes. Even many other funds, bigger funds, are taking a closer look at how the underlying stocks, in this case REITs, are adopting an ESG practices. So what this basically means is that a REIT which is good in ESG practices will have a lot more fund following, thus commanding a better valuation. Second point, the underlying assets of REITs are again properties. And when tenants are, especially the larger tenants, institutional tenants in developed markets, when they are looking at assets to rent, the key thing they also look at is that how is that asset positioned in ESG? Is it a sustainable asset? Is it a green mark platinum asset? And tenants place a greater emphasis on choosing these kind of assets to rent. So thus a tenant base or the increase in the tenant interest is also going to increase if your assets is more ESG certified or ESG follows best ESG practices. Third, again, we are seeing this clearly in various fundraising activities in this market. A REIT which has best ESG practices are able to issue green bonds, sustainability backed bonds, and even green perpetual securities for the recent examples. And what this green bonds and this ESG backed fundraising ensures is that it lowers the funding cost compared to that of typical bank borrowings or typical debt cost. It lowers the cost by at least 20 to 30 basis points in some of the recent example, which means again the cost of capital for REITs is getting cheaper, which means investors are in the end, for what it means for investors is that you're going to get a better yield or higher yield accretion. And last but not the least, following best ESG practices has also proven that operating cost of the REITs will come down over a longer period of time. So start focusing on ESG practices and how REITs are also focusing adopting on the ESG practices. And whenever a REIT, when you're investing in a REIT, look out for what kind of ESG practices the REITs are investing. So that would be the second key point that would make a resilient REIT. The third most important point, again, this is particularly important in this crisis and how it has impacted, is that asset quality and lease structure. COVID-19 has shown the importance of having a strong asset back quality and the tenant mix or how tenants play a vital role in this crisis. So if you have a very good quality assets, no doubt, despite crisis or not, there would be a good set of tenants who are always in demand for that kind of assets. So that would make it resilient across the market cycle. And again, tenant mix in terms of quality of tenants as well as the lack of concentration ratio also helps a REIT in terms of future proofing and making it sustainable and more resilient. When I say concentration mix, it also depends upon the quality of mix of tenants. For example, the light commercial REIT, which would be presenting this webinar, also has 100% tenant backed by UK government, which is the biggest blue chip tenant you can have. So despite concentration risk, the risk of tenant default in terms of those kind of tenants is very low, which makes the REIT resilient across market cycles. Investors also have to place an importance in terms of whether the other asset is a freehold in nature or a leasehold in nature. Most of the assets in Singapore are leasehold in nature. That's why we are also seeing a lot of REITs diversifying away into overseas markets so that they get a balanced mix of a longer lease term portfolio and mix it with Singapore lower lease tenure kind of market. The most critical factor is the weighted average lease expiry. This is basically how long a lease is locked in by the REIT. Why this is critical is that, especially in these uncertain times, when the tenant's lease comes up, tenant has a lot of questions in the mind. Should I renew the lease? Should I have to forego this lease? Should I reduce the space? Should I reduce the space, etc. But in general, if the REIT has a longer tenant, if the REIT has already secured a tenant for a longer period of time, let's say if the economy is bounced back in 2021 and 2022 and the underlying company does well, that means that there is a more chance that this lease is going to be renewed at that point of time. So the longer the wait, the shorter the uncertainty in terms of income for the REIT. So investors have to focus on how long the veil of the portfolio is, and that would provide a bit of income certainty, especially in crisis like this. As every investor's uh, key reason for investing in a REIT is having an yield certainty and providing a stable yield. The veil plays a key role in terms of providing this income certainty. Investors also have to look out for the veil from a master leases. And suppose if there is a master lease backed veil, whether the master lease is sponsored master lease or other master lease, how good is the tenant? Can the tenant pay rents in time? This has been unfortunately proven in terms of the Eagle Hospitality Trust case, where the master lease unfortunately couldn't honor its lease and has defaulted, and has resulted, despite a longer master lease, the REIT has went into a default. The other thing is also the underlying rent escalation clauses, which provides an organic DPU growth for the investors. Usually overseas leases like Australian leases, US leases, portfolio with the Australian US markets have an underlying rent escalation. And what this basically means is that you will get a natural 2 to 3% increase in distributable income, and that means higher DPU from these assets every year because of this organic rent escalation clauses. Moving on to the next factor, I think the next key factor which I would be looking at is the gearing and the debt profile of the REITs. As we all know that gearing is a double-edged sword, especially in times of a crisis. A lower gearing is better, but in times of better market conditions, and higher gearing would perform would have a better DPU returns. So what should be the gearing of the REIT? Or the gearing differs from REITs to REIT as well as sectors to sector. As I have highlighted before, MAS has increased the gearing limit for the REITs from 45% to 50%. I would say the REITs in general are mostly not overly geared at this point of time. The average sector gearing is still around 37%. I would say the optimal gearing for the REITs typically look at is 35 to 40%, which is the investor's comfortable level. But since now the gearing limit has increased to 50%, some of the REITs has also geared up to 42, 43%, which to me is the threshold at which REITs should tend to reduce their gearing back to 40% levels. This is a prudence measure. Just as I said, a REIT, just because a REIT has a higher gearing doesn't mean bad, and a REIT has a much lower gearing, it doesn't mean it is good. But what happens is that if a REIT has a lower gearing, it has a much better potential to do an accretive acquisition, and it has a much better capability to go and acquire in the market when opportunities arises compared to a REIT with a highly geared position. The other thing also investors should take note is that how is the balance sheet in terms of loan profile, whether there is a spike in interest rate could have a negative impact on the REITs, and is there a currency mismatch in terms of debt as well as the income, something investors should focus on for ensuring a REIT is resilient or not. Moving on to the next factor, I think this has been highlighted before also. Diversification pays, and diversification is very important in a crisis. Having a diversified portfolio in terms of both geographies, asset class, and tenant is very critical to future-proof the income. We have seen some examples of REITs recently doing this. I would say a classic example is that Capital and Retail Commercial Trust has recently broadened its mandate to acquire China properties across a wide range of asset class. And recently they have made an acquisition in business parks. Again, this move is a classical diversification move to hedge its portfolio against uncertainty faced by retail sector. We have also seen mergers and acquisitions. Capital and Commercial Trust and Capital and Retail Trust, Capital and Mall Trust has merged together to form Capital and Integrated Commercial Trust. Again, this is to diversify the portfolio risk and take advantage of the future opportunities and future-proof the assets. So diversification going forward is also one of the key factors for a REIT to be resilient across various market cycles. The last but not the least point is that a good sponsor, a capable sponsor, a sponsor with a track record, as well as a good management team definitely is a plus in the market cycles. We have seen good examples of some of the good sponsors, how they have helped the REITs in times of crisis, and we have also seen some negative cases recently of how a, a, a non-reputable sponsor can lead to an adverse outcome for the REITs. So again, a good sponsor, examples of a sponsor roles would include, let's say, creating a good pipeline for the REITs to grow. Obviously, REITs would want to expand their presence. REITs would want to enhance their portfolio to make it future-proof. As I said, they have to diversify, they have to future-proof their income, so they want to grow. A good sponsor is one who can identify these good opportunities for REITs. And at times of crisis, can also show some support in terms of fundraising. A classical example, I would say, a good example I have seen recently would be, again, I would say, go back to a light commercial REIT. They have made an acquisition of another 58 properties in UK recently. And what we have seen is that the sponsor has come out in support. They have underwritten a large portion of the equity fundraising at a price which is actually above the current traded market price. Again, this is a benchmark which has been set by a light commercial REIT. And it shows that the sponsor is committed to help the REIT and grow the REIT in the longer term. So a good sponsor, watch out for the moments of how sponsor is reacting when the REIT needs these kind of crisis and how the sponsor is doing in terms of acquisition. That would again make a REIT resilient, and those are the REITs which are primed for excellence in a longer term. So these, I would say, as I said, I have kept it more prescriptive in nature. Every investor should analyze the REITs from these factors, from above these 6 factors which I have mentioned, in terms of how their investment or how the REITs are reacting to these factors. That would make a REIT resilient and the dividend income much more stable in over a longer period of time. Let me just move on to the brief sector outlook for the various sectors. In terms of sector preferences, from a resilience to a least resilient point of view, our sector preferences are industrial, followed by office, followed by overseas commercial REITs, followed by hospitality, and followed by retail REITs, which are at the last, mainly because of the challenges faced. Industrial REITs, what makes industrial REIT resilient? Because industrial REIT has relatively emerged unscathed from this crisis. If you look at the work from home trends, or if you look at how the things has changed, most of the things which has changed because of COVID-19 is some way or other helped the industrial REITs, especially sectors like data centers. Most of us are working from home. The data has exploded, and the outlook for the data are going to be projected to be much. Usage of data is going to be much higher. This means obviously data centers are going to benefit in the long run, and that's a sector which many investors are watching out for. The next biggest sector which has come up as big interest is the logistics sector. And what this COVID-19 has done for the logistics sector is that previously businesses were using the logistics as a just in case, meaning they purchase their inventory, just in time. So meaning they purchase their inventory just in time to assemble and do the end product. But this has moved from just in time to just in case because there has been some supply chain bottlenecks across various markets because of COVID-19 lockdown. So what? Not just companies, even governments are doing stockpiling, and companies are also ordering their inventory in advance and storing them in the logistics or warehouse facility. So this has created a great boom for the logistics facilities, and even business parks has also benefited because of the displacement of some of the office to suburban places, and also the tech demand for the business park sectors. Just judging by the industrial data points which has been coming out, we have been seeing a lot of positive signs in the industrial data points in Singapore economy recently. PMI data has been rebounded sharply since touching a lows in April, and it has been rebounding sharply, as you can see from the chart. Not just PMI, many manufacturing output has been rebounded. NODS has been pointing in the right directions. What this means is that industrial sector is gaining food and has been recovering so far from this crisis quite well. A similar data is reflected in the JTC's data points. If you look at the JTC's data points for industrial sector, the overall occupancies for the industrial sector has been inching up a bit and it's closer to 90% in the recent quarter. So the occupancy has been stabilizing recently. If you look at from the rental perspective, the rentals has been more or less flattish to slight negative, but so far the rents has been holding up well, and in some specific sectors like data centers and logistics, rent has in fact been rising in the recent market trends. Looking at from the supply and demand perspective, although there is a bit of supply in terms of the industrial sector, most of this supply is concentrated in the factory space. Factory space is still a weak point in the Singapore industrial space. There is still a bit more of supply compared to demand. So the factory sector's rents are still expected to come under pressure. But other than that, the outlook in terms of rents as well as occupancies for sectors like data centers, business parks, high-tech buildings, logistics still remains positive in terms of both in terms of occupancies as well as rent outlook wise. And overall, from rent relief perspective, rent relief has also been very minimal for this sectors. The one key risk to watch out for would be how the SMEs are coping up when the government stimulus is tapered. But government has been very careful so far, and they have understood that SMEs are the critical engine for Singapore market, and thus they have been careful in terms of giving the pulling off the stimulus from the economy. So overall, the outlook for the industrial sector in terms of dividends is still positive, and we expect this sector to remain most resilient in 2021. The next sector, I think this has been the most talked about sector, is that a lot of talk has been there in terms of how office sector is impacted, and many have been predicting that this is the end of office with most of the people working from home. In general, our view is that although there has been a lot of change in COVID-19 has changed a lot in terms of working from home trends, etc. We don't think so office sector is dead. There's going to be some change in terms of office sector in terms of core plus flex model is what we are seeing, that more companies are preferring to have a bit more of flexibility in terms of working space rather than having an employees 5 days working in an office. Is it possible to have a 3-day working and have a 2-day flexible schedule, flexible system? Is what most of the companies are thinking about. There has been very little companies who has been saying that let's all go work from home purely after this COVID-19. So most of the companies are looking at a core plus flex kind of working model is the approach which most of the companies are taking at this point of time. So what we expect from this corporate, so we have definitely seen some downsizing and right sizing in office spaces because of this COVID-19 crisis. Mainly, you can see financial sectors, banks have said that they are going to trim down some of their spaces, which they think can be moved to a remote location or moved to a out location or can be done from home. So they have been trimming or right sizing some of the spaces. So overall, what we have been seeing so far is there has been some reduction in terms of this demand by right sizing and downsizing. But on the other hand, we are also seeing some new sectors, especially technology sectors, emerging as a bright spot, as well as the flexible operators emerging as a bright spot and increasing demand. As I said, the reason for the technological sectors picking up is also because of the US-China trade tensions. A lot of Chinese technology firms have been looking for expanding their spaces in Singapore. Examples include Tencent, ByteDance, Alibaba's, Lazada, which have all been increasing their spaces in Singapore office market. This has in fact somewhat offsetted some of this demand reduction from the tenant downsizing and right sizing. So overall, although we do expect office demand to reduce by 5 to 10%, we still do not see a collapse in office demand. Looking at from the supply front, for the next 4 years, about 0.8 million square feet per annum of supply is going to come. You can see in this chart. This is actually about 20% lower than the 10-year average historical net demand of 1 billion square feet. So the supply front is also, I wouldn't say it is excessive. And you also have to take into consideration that there could be some construction delays, which can push back some of the supplies also. So overall, we do expect some pressures in terms of occupancies. Vacancy rates are expected to rise a bit. Rentals are also expected to decline by about 5 to 10% this year and 5 to 10% next year. But what is good for the office sector, or for especially for the office REITs, is that most of the leases that are coming up for renewal for office sectors or office REITs in the next 1 2 years are signed during the 2016, 2017, 2018 period. During that period, you have to note that the rents were about 20% below what the current market, 15 to 20% below what the current market rents are. So most of the rent expiry for the office REITs are still below the current market trends. What this means is that office REIT landlord has some leeway in terms of negotiating the leases, and even if they are reducing the rents compared to market rents, they can still eke out a positive rent reversion, which is positive for office REITs in general. So it's not a doom and gloom for office. We still maintain a neutral view, but we still see a selective opportunities in terms of office REITs, both Singapore as well as overseas office REITs. Moving on to the next sectors in terms of our preference is that I think this is a sector which has clearly been impacted the hardest in terms of COVID-19 crisis. Hospitality, I think nobody would have expected it. There would be a day when the world would come to a standstill, when we cannot travel, when what we have been taken as granted would be taken away from us. 2020 has been a very bad year in terms of global travel. All people have been stuck at home, and global travel has come to a grinding halt. As such, hotel REITs have been impacted quite badly. But from a Singapore hotel REITs or a Singapore hospitality players perspective, there has been quite a bit of supporting factors we see. Only there are 3 4 REITs in Singapore hospitality space, but there has been quite a bit of supporting factors. First, we have to take note is that many of the Singapore REITs has a bit of master lease component with the minimal rent guarantees. So despite occupancies collapsing to 30-40% in these kinds of time, the REITs rental or the REITs income is not going to go zero. So there is some minimal master REIT guarantee income. That means you would still get a dividend yield for this year's for most of the hospitality REITs. Singapore has also so far contained this crisis well. They have been promoting domestic tourism, and the government has also been supporting the hospitality players both in terms of job support schemes, which has been alleviating some of their operating costs, as well as stay-at-home notices. Most of the people who are coming from overseas, government has booked in a lot of these hotels for stay-at-home serving their stay-at-home notices. This has given actually some base occupancies and base revenue for hotels, thus managing them to break even at this point of time. Again, from an hospitality sector point of view, the reason why we like this sector more than retail sector is that for us, we think hospitality, this is the COVID-19 is a speed bump, not the end of the road. When things come back to normal, for example, you can see how the hospitality sector stocks has jumped back when the vaccine announcement has been announced recently. So what happens is that when a vaccine comes or when things slowly return to normal, which in our view is going to come somewhere in the second half of 2021 or 2022, is that you are going to see travel come back, and there is a good possibility of a revenge travel. People who have been not able to travel this year, or people who have been waiting to travel in the 2021, there could be a lot more of people traveling when the travel comes back. There could be an increase in the events which has been planned to happen in these 2 years that could come in the years when travel comes back. So to this, for us, hospitality sector, this is a speed bump. Once things starts coming in place, I think hospitality REITs would rebound much stronger than rest of the other sectors. But the big question mark is that when is this travel going to come back? That's a big question mark. Our expectation is that possibly a vaccine and global travel should start slowly normalizing by second half of 2021. So in terms of outlook for the hospitality sector wise, we think it is more of a catalyst driven, but we think hospitality sector should rebound strongly. And from a returns perspective, hospitality sectors still offer a better upside from this point of time. Last sector also I would say is that from a Singapore perspective is the retail sector. We are negative on retail sector sadly because this sector has been facing a lot of structural challenges caused by COVID-19. As we can see in this market, uh, COVID-19 has impacted a lot of retail players, and it has resulted in a lot of structural impact both in terms of online shopping as well as e-commerce uh, uh, rise in e-commerce rising e-commerce. So Singapore retail sales, as you can see from this chart, has been on a declining trend for 19 months since the start of 2019. Online sales has also increased. So overall, if you look at from a near to midterm perspective, retail REITs are going to undergo quite a bit of challenging climate in this market condition. So we expect rents as well as vacancy to rise for the retail REITs in the near term, creating some pressure. In terms of other sectors, healthcare and overseas REITs are the key other sectors. Healthcare REITs are generally resilient, but investors has to take into consideration how is their master leases, especially, and what is the sustainability of the income. For overseas REITs, our preference has also been US commercial REITs. In general, commercial REITs, which has a longer veil, including the Elite commercial REIT, which is UK commercial REIT, which has a longer veil, is among the sectors which should be more resilient at this point of time. And the other thing which is attractive about the overseas commercial REITs are also the trading yield of the overseas commercial REITs are much higher than Singapore REITs, thus providing an attractive investment option. Just quickly in terms of some of our picks, mainly on the small mid cap or the mid cap space sectors. But there are other stocks which I would be happy to discuss in the live Q&A sessions if you have any questions on 21st of November. We like SATTEC REIT mainly because we think from a valuation perspective, it is attractive at 0.7 times price to book. In terms of earnings, we are also expected to see some improvement because most of the development assets which are under construction have completed recently. Office portfolio has been relatively resilient and should mitigate some of the risks of a retail and convention assets in its portfolio. The REIT has also been diversifying some of its presence across overseas markets, which should contribute positively. So this is one of the REITs which we prefer from an office REIT perspective. The next REIT is Manulife US REIT. Despite US being the severely impacted in terms of COVID-19, a long veil as well as a good asset quality and good tenant base has helped and is going to be a key reason why we like this REIT despite market conditions. Occupancy has been relatively stable for this REIT so far. Rent reversions are still positive. We still expect rent reversion to be in the flattish to slight positive going forward. And the most important factor is that the yields of these REITs are still at about very high, at about 8%. If you compare to Singapore office REITs, which are still around mid 5 to 6%, there is a good bit of yield gap, which we think is unjustified for an US commercial asset, which is freehold and which has an inbuilt rent escalation. Last but not the least, in terms of industrial space, we like Asanta's REIT. Why? Because it is the most diversified REIT and it is the biggest industrial REIT by market cap. It has a good exposure to business parks. Recently, it has been expanding its portfolio into data centers also, and it is strong sponsor backed, and it is the biggest REIT, which has a dividend yield of 5% at this point of time. Although valuation wise, we would expect the REITs valuations are slightly high at this point of time, and we would recommend investors to buy on any of the pullbacks. As I mentioned, these are some of our top 3 picks. There are many other REITs in the space which we still have an interest and which we'll be happy to take during the Q&A sessions.
Thank you for watching today's session. Do submit your questions on the link below, and we will strive to answer all of them during the panel discussion, which will be conducted in Zoom on 21st November at 2 p.m. Please tune in then, and we will see you tomorrow.